Is housing inventory about to go negative? My name is Dennis Wells. I'm a mortgage advisor and a student of the financial markets. And here's my weekend update for you for April 17th, 2026. As I mentioned before, inventory is the big story right now. Since mid June 2025, we've been noticing that the housing market dynamics have shifted, and this shift could create some negative year over year inventory in 2026. And if the Iran war did not happen, we might have already seen this. The first 3 months of 2026 has shown the lowest mortgage rate curve for several years, which has been one big driver of the inventory growth slowing down nationwide. A lot of this also has to do with very hard year over year comparables, as inventory growth was good last year, but very similar to 2023, when rates get towards 6%, the growth rate of inventory just doesn't grow as fast as it does when rates are above 7%. In addition, this weekend update also shows some of the impact of the Easter holiday, but still, the growth rate of inventory is slowing down enough to possibly get negative national year over year data soon, like we are seeing in some specific parts of the US. So let's jump into housing inventory. Inventory is seeing its traditional seasonal increase, and while we are on the verge of going negative over last year, inventory is in a much healthier spot than we were in the COVID years. Easter weekend did have some impact on the data, but the growth rate is really running into hard comps until we get to mid June. We have gone from 33% year over year growth in inventory at the highest point in 2025 to 3.21% last week. In the past, inventory growth picked up amid higher mortgage rates, softening demand, and rising year over year new listings. Even with the Iran conflict pushing mortgage interest rates higher from close to 5.99 to more towards 6.64%, 2026 has had the lowest rate curve for the housing market to work from since 2022, and rates have not been above 7% in a while. So when we look at weekly inventory change, inventory rose 726,460 to 724,977. The same week last year, April 4th to April 11th, 25, inventory rose from 691,000 to 702,000. Now let's talk about new listings. I've been a little disappointed with the new listing data so far this year, as we were hoping that we would get some weeks where new listings ranged between the 80,000 and 100,000 new listings per week during the seasonal peak months, which would be what we would see in a normal year. Last week, new listings were again negative year over year. We can attribute some of that data to the Easter holiday, but it's still been a disappointing year with new listings, as it looks very hard to get to the range we'd like to see. For context, during the housing bubble crash of 2008, new listings ranged from 250,000 to 400,000 new listings per week for several years. So the new listings data for the past 2 years, 2026 was 70,244, 2025 76,271, showing a net decrease there. Let's take a look at the price cut percentage. Typically, about one third of homes undergo price reductions before they sell, and this reflects the dynamic nature of the housing market. As mortgage rates and inventory rise together, the percentage of price cuts increases. Still, the percentage of price cuts nationally is slightly below this time last year. The price cut percentage for last week, this year, 34.3%. Last year, 35%. 10-year yield and mortgage rates. Last week, we saw the 10-year get as low as 4.23 due to the ceasefire news, but ended the week a little bit higher than that at 4.32. As we all wait to see if the ceasefire can hold, and with the blockade in the Straits of Hormuz, we'll see how that all plays out. But even amid higher oil prices, the 10-year yield has not reached its yearly high, holding mostly steady with news about the ceasefire and some hotter inflation data that we've seen lately. Mortgage rates didn't budge too much this week either, as they started at 6.43 and ended their week at 6.39%. Now let's talk a little bit about mortgage spreads, the difference between the 10-year treasury and mortgage rates. Mortgage spreads remain a positive story for housing in 2026, as mortgage rates would have easily been over 7% in 2023 and 2024 and closer to 7% in 2025 with the current 10-year yield level and the worst spread levels of those years. The spreads were actually getting a little bit worse in February as yields fell, compressing volatility on the downside, but then they got even worse due to the war, but again have moved slightly lower. As you can see, we are still at better levels now than we were for the past 2 years. Historically, mortgage spreads have ranged from 1.6 to 1.8%. Last week, spreads closed at 2.05%, down from 2.11 the week earlier. And again, if we compare last week's rates to the worst level of the spreads over the past 3 years with the 10-year yield at its current level, in 2023, mortgage rates would be 7.45 today, not 6.39. The worst levels of 2024, rates would be 7.08 today. If we had the worst levels of 2025, rates would be at 6.88% today. So still about a half a point better than where we were last year. And a lot of that is attributable to those mortgage spreads. So they're really the hero of the story today. Weekly pending sales. Our weekly pending home sales data provides a week to week perspective. And although the results can be affected by holidays and short term fluctuations, such as the Easter weekend, housing demand has slowed down with higher rates. And last week we were down week to week and year over year. Again, some of this has to do with Easter weekend, so we'll talk more next week when we have some updated data there. But weekly pending sales usually take 30 to 60 days to hit the sales data. And with mortgage rates around that 6.5%, if they break to 7, that really impacts the data. Under 6.25 has been the sweet spot over the last several years, excluding some short-term variables that we've seen. Weekly pending sales last week over the last 2 years, 2026 was 68,864. 2025 was 71,632. Now let's look at the mortgage purchase application data, because purchase application data is a forward-looking indicator. Growth here leads to home sales by roughly 30 to 90 days. Last week, we saw a week-to-week growth of 1%, but purchase applications were down 7% year over year. So higher mortgage rates are impacting this data, but nothing too dramatic so far. We did have a hard year over year comp to work with. So again, it'll be interesting to see next week on the update where we are on that. And for purchase applications, what we really want to see is at least 12 to 14 weeks of positive week to week data. If we can get that positive week to week data to go with year over year growth, then we are really in a good position. And for 2026, every week has shown positive year over year growth, but that growth rate has slowed over the last 2 weeks. So what we found so far here in 2026, 6 positive week over week prints, 6 negative week to week prints, 1 flat week to week print, 7 weeks of double digit year over year growth, 12 weeks of positive year over year growth, and 1 negative year over year print. As we look to the week ahead, we're still looking at Iran, durable goods, and pending home sales. Monday, we get pending home sales. Later in the week, we'll get initial jobless claims, new home sales, and the durable good orders for March. But again, I stress it's all about Iran right now. Once we can get this conflict behind us, we can move back to a normal economic discussion that is not so much tied to this war. I hope you have a great weekend. If I can help you with anything housing related, feel free to reach out to me directly. And again, my name is Dennis Wells with the Wells Funding Group. Hope you have a wonderful weekend.